Hello class, welcome to the chapter 2 lecture video. We're really getting into the heart of managerial accounting now with what we're going to talk about in this video. And I really debated on whether I was going to make it into 1 or 2, because it is kind of it's kind of broken down into a couple different sessions what we're going to talk about. But I'm going to do it all in one video, but I understand it's going to be a little bit longer this way, so maybe you might want to pause it, watch half now, half later. But the first half of it, we're going to talk about different types of costs, okay? Because we're not dealing with expenses anymore. Now we're going to be dealing with costs. We'll talk about that in a minute. And then in the second part of chapter 2, we're going to be making some statements: a cost of good manufactured statement, a cost of goods sold statement, and an income statement. Okay, so that's kind of how chapter 2 breaks down. It kind of lays the foundation for everything else we're going to do throughout the rest of this class. So let me get my slideshow going here. The screen shared, and we'll jump right into chapter number 2 here. Oops. All right, cost. So I said managerial accounting, we're going to be worried about costs. And when I'm talking about costs, what I'm talking about is the actual amount of cash that is going to get paid out. What we're either paying today or we're going to pay sometime in the future. But we want to know is that total number. Okay. How does this differ from financial accounting? Well, in financial accounting, we were more worried about expenses. And the difference is expenses, we were worried about maybe taking costs and getting them in the right time. Okay, putting them in the right period onto our income statement. Okay, and that is to meet those external reporting requirements. Whereas managerial accounting, we're not really worried about those external requirements, except for one, as you're going to see about halfway through this video. But we're not worried about that timing so much. We're worried more about costs. Okay, the actual dollar amount. Okay, and we're going to assign costs. Is the way we're going to link a cost to a cost object. What is a cost object? It's any item that we can assign costs to. Okay, for the most part, when we're going through this class, we're going to assign costs to a product that we're manufacturing. Okay, in the real world, maybe you're going to be an accountant for a company and they want to know how much you're working for a car dealership, and they want to know how much does us cost us per sale of car. Okay, so the car sales would be your cost object, and you want to find out how much it costs, you know, how much in overhead, how much are we paying or our labor to be out there, how much in inventory do we have to hold to make one sell, stuff like that. Okay, it can be anything. Okay, anything you want to find a cost on. There are different types of costs. And that is the first thing we need to be able to do in this class, is to identify what type of costs we have. First, there's direct versus indirect cost. Okay, direct costs can be easily traced to a cost object. Okay, indirect costs, they cannot be easily and accurately traced to a cost object. Okay, so our cost object could be anything. Direct cost, you can directly trace it to there. Indirect cost, not directly, but it is part of the cost object. So if we're talking about the production world, okay, say we are making a desk, okay, this thing right here that I'm sitting on, this little podium right in front of me, okay. A direct cost we can tell this would be the cost of the wood. Right? If we were manufacturing it, that would be a direct cost. What would be an indirect cost? Something that costs the wood, but we can't really tell. Well, I bet they put glue in here, okay, to help hold some of these pieces together. Okay, they didn't use the whole bottle of glue. How much of the glue did they use? Did they use 2 cents worth? Did they use 7 cents worth? We really don't know, but we know they use some glue. They probably made a whole bunch of these. So that glue would be an indirect cost. Let's try another example. How about to cost to take this class? What is a direct cost to the school? You think of anything? Well, it'd be my salary. Okay, they can directly trace how much they have to pay me in order to sit in front of the class and teach. What would be an indirect cost to the school for me teaching my class? Okay, think of anything? How about the electric bill? Okay, right, they gotta keep electricity on throughout this whole building. I definitely need electricity to teach my class, but how much of the electricity bill am I using? Okay, that would be an indirect cost. Okay, they can't directly trace it to my class because if my class wasn't here, the cost would still be there. Whereas if I was not teaching this class, my salary would not have to be paid. Therefore, that is a direct cost. Hopefully that kind of helps you understand, because that is always the first thing we're going to identify. Is it a direct cost or an indirect cost? Okay. Just a few other categories of costs. We're really going to get into variable and fixed cost into chapter 3. We just know what these are in chapter 2, maybe for some homework questions. Variable cost. Okay, total cost increases the more we produce, and total cost decreases the less we produce. It varies based on production. Fixed cost, whereas the total fixed cost is going to stay the same all the time. Okay, so a variable cost. If we were producing something, all the material that we needed to produce it would be a variable cost. Because the more we produce, the more materials we have to buy. Whereas a fixed cost would be the rent on the building that we're making these, whatever we're making in there, okay? Doesn't matter if we're making 1,000 a day or 2,000 a day, our rent is going to stay the same. That is a fixed cost. Opportunity cost. Okay, we'll talk more about that when we get into decision making, but that is the cost of giving up, the benefit of giving up something when you're making one choice over another. Okay, so now back to kind of comparing costs here. First, we're going to decide if it's direct or indirect. Next, we need to decide if it is a product cost or a period cost. Okay. Product costs are anything that goes into producing a product. And as you're going to find out, there's a lot more than you would think, because anything that has to do with producing the product. So we're talking about the direct materials, the indirect materials, the direct labor, the people that are out there working on it, the indirect labor, the supervisors of those people who are directly on the line making that product. And then we get into manufacturing overhead. Okay, it's kind of a preview of our 3 little product costs here. And that is anything that has to do with production, such as, we got to pay insurance on the workers. We got to pay insurance on the factory. Okay, we got to pay utilities. We got to pay the rent. Okay, we have depreciation on all the equipment that is in there making this stuff. Okay, anything that goes into production is called a product cost. Okay, and this is where we're going to also find out, kind of jumping ahead when we get to some of these slides. I'll just skip over them because I've already talked about it, but this is the one rule that we have to follow in managerial accounting, is that we got to make sure all product costs become product costs, because product costs become part of our inventory. Okay, and then we expense our inventory as cost of goods sold whenever we sell it. Okay, so I erase those two. Okay, I thought I erased those slides and took them out. Kind of just talking about service company there. No, more should look them over, but it's not about what your questions are going to be about. So anyway, determining product cost. As I kind of went through, there are 3 different parts. Okay. Product cost are direct materials, direct labor, and overhead. On your outline, I call it manufacturing overhead. And when I start doing examples on the board and writing it, I will write it as MOH, manufacturing overhead. Direct labor, you'll see denoted in stuff now as DL, and direct materials as DM. Okay, direct materials are just what they say. It is the materials that we can directly trace to the product. Okay, direct labor, the labor that we can directly trace to the product that we're making. Overhead is everything else, okay? All those indirect costs, anything that we cannot directly trace, because what possibly can we directly trace, right? The materials and the labor, nothing else can be actually directly traced. So everything else is indirect. Indirect materials, indirect labor, and all other indirect costs are overhead costs. Okay, overhead is a big number for businesses. Okay, when I was at the last school I was at, like these examples, I had an entrepreneur come in and speak to a business club that we had there. And he ran a catering business, and they asked him one of the students asked him what was the biggest surprise that he had when he was running his business. And it's funny because at the beginning of the semester we were just talking about this. And he's like, it is the overhead costs. If you think you're going to start a business, imagine what your overhead costs are going to be, and then multiply by 3 or 4. Okay, because there's so much expense in there that you don't realize. All right, but all of those have to go in there. So direct materials, what I said, our final product can be directly traced. Direct labor, labor that can be directly traced to the goods being produced. So that's the person working on the assembly line. Maybe and you can trace it to that batch of work. But there's also indirect labor. So the manager that's overseeing the whole factory, okay, so the factory line workers, direct labor, factory supervisors, indirect labor, okay, because they might be overseeing several different line workers making several different products. And then manufacturing overhead, as I was saying, everything else other than direct materials or direct labor are manufacturing overhead. They are all of the indirect costs. And then there's just some examples for you. All right, so once we know how much, why are we doing all this? We want to know how much our products cost. Okay, the direct materials plus the direct labor plus the manufacturing overhead equals total product cost. And then we can divide it by how many units we produced, and we can get a per unit cost. And now we'll have some idea on what we need to set our selling price at in order to make the kind of profit that we desire to make. So here's an example. We're making some blue jeans last week, direct materials. So you give some great examples here. To make blue jeans, the denim, threads, zippers, and rivets, you can directly trace, how many of those you use in each of them. We're 48,000 we're putting in production. Direct labor, very good. It gives us exactly what we need there. The number was incurred. And then it also told us what manufacturing overhead equals. So it gave us all the indirect costs. It's nice of them not to list it separately. What is the total product cost? So we're gonna take our 48 plus 30,000 plus 72, right? 150,000 per unit, 150,000 because we made 30 unit, $5 per unit. That's what was the cost of the jeans. So now there's some other costs we need to take in, those selling and administrative costs we're gonna talk about in a little bit. But we know our product, it cost us $5 to make that pair of jeans. Right, so we can set our price accordingly. Some other little things that are mixed in that I might ask you about in the homework question, and it's good to know, prime cost. If some of you hear somebody talk about prime cost, it is probably the most important things of making the product. It is the direct materials and the direct labor, those direct costs. Those are considered your prime costs. And then conversion cost, I like to remember it this way. It is the cost of converting direct material into the finished product. So your conversion costs are your labor and your overhead. It's good to know those conversion costs, whatever. There's a chapter I'm leaving out where this is very, very important. And it's definitely very important to know these when you get into your intermediate classes. All right. So if something does not help make the product, okay, we considered a period cost. A lot of stuff we're going to see here, we're going to be looking at when it's a period cost. It is something that happens at the corporate office. Okay, so anything that happens at the factory, maybe we have a factory where we're making furniture, okay? We have it in one town, in another town, we have our office where all our accountants sit, and the CEO and all the marketing. Okay, and maybe that's where our store is too, and we're selling the furniture out of that store. Okay, all the costs associated with that store, the selling and the administrative expenses that go on and running the business that don't actually have anything to do with making the product, those are called period costs. Okay, that's why on your outline there it has product versus period. Period costs get expensed immediately as soon as they are incurred, and they do not become part of our inventory. Right? They are broken down into two sections. They are selling costs and administrative costs. Here it gives some examples: office supplies, research and development, CEO salary, advertising. This is just a good flow here. Product costs become part of inventory. Period costs, no, either expense, or if we do buy equipment, I guess that would be a period cost, but it gets gone through depreciation. There's selling costs. Okay. This is not your cost of goods sold. Remember that comes from your product costs. Everything that it costs to make the product. Selling costs, paying the sales commissions, okay, advertising, running commercials on TV, radio, okay, storing. Maybe you have a sales floor that you got to pay rent on, okay, shipping, customer service representatives, and I'm not moving around enough for my life. Whereas administrative costs is what goes on with the general administrative buildings, executive salaries, legal fees, accounting fees. Okay, research and development. Okay. So that is kind of the first part of this chapter, is being able to look at costs and identifying them. Okay, cannot stress how important that is. So moving forward, being able to identify whether it is direct and or indirect, and then after that, whether it is a product or a period cost. Okay, you can actually kind of do that in reverse order. And that's what I do. When I look at something, first I think, is this a product or a period cost? Okay. It's a period cost. I know it's going to be expensed immediately. And it's nice to know if it's direct or indirect for practice sake, but for practicality, it really doesn't matter. If I determine that it's a product cost though, then I do need to know, is this direct or indirect? If it is direct, it either has to be direct materials or direct labor. Okay, if it is indirect, I automatically know that it is manufacturing overhead. Okay, so that's the first part of this chapter. Get this one down, and then we'll start putting some numbers to this. So our next part here is preparing income statements. Well, to get to the income statement, first we need to make a cost of goods manufactured. What a cost of good manufactured is telling us is we're looking at all of our product costs there. What it's going to be is going to be our direct materials, our direct labor, and our manufacturing overhead. Okay, all added together for everything that we completed during the period. Before I get started on that, I don't have a slide for this, but I have it in your outline there. You need to understand we're doing manufacturing companies here. So we're going to have 3 different inventory accounts now that we're going to be working with. We're going to have the raw materials inventory. Okay, and that is just everything we bought, all materials, could be direct materials, could be indirect materials, goes into that raw materials inventory. Then we have a work in process inventory, or it could be listed as work in progress. Either way, when I write it out, I write it as WIP, the WIP. Okay, so our WIP inventory, that is inventory that has been started but not yet completed. And then finally, we have our finished goods inventory, the FG, the good old field goal. Finished goods inventory is stuff that we have completely produced and we have it ready to be sold, either sitting on a sales room floor or in our warehouse somewhere ready to be shipped out. Okay, so when we're making a cost of good manufactured statement, what we are trying to find here is what was the cost of the goods we completed this period? So my slides go kind of out of order here. So I'm gonna go to this one first. I like number 2 better, 2 of 3 better than 1 of 3, and we'll go back. Okay. I have this written a little bit different on your outline. Okay, and on your outline, I tried to make it like a math equation. I should have just, instead of numbering them 1, 2, 3, looking back on it, I should have just left that off, put the math symbols on the left side. Okay. It's the same thing we got going on here with this slide. It just puts the beginning work in process down at the bottom. Okay. But to find our cost of good manufactured, we're going to take all the direct materials that we used during the period. And that was that slide I just skipped. We'll go back to it in a minute. The direct materials used, plus the direct labor used, plus our manufacturing overhead costs. Okay, our 3 product costs, plus our beginning work in process. Okay, so we already had some costs there. Okay, and then we subtract out our ending work in process because everything's not completed, the cost of what we still have left sitting there that we're working on. That is the amount that gets transferred out as finished goods. Okay, that is a cost of goods manufactured. The first calculation you have to do in there is that direct materials, how much direct materials were used. Well, to find our direct materials used, we take our beginning materials inventory plus purchases. Okay, and I have this on your sheet. A lot of times you may not know exactly how much you used. So we do some just algebra flipping here. We minus ending inventory. And that will equal how much direct material was used in production. Okay, you kind of flip that formula around there. Okay, because in your homework, you're going to see that's a lot of time that's what's not given there is the direct materials used. It gives you your beginning inventory, you know how much you purchased, you can go look, you can count how much you have at the end. So you have to find out how much direct materials you actually used. Okay. And then you take your direct materials used, plus your direct labor, plus your manufacturing overhead again, get you all of your labor or all of your product costs. Add in your beginning work in process, subtract out your ending. That equals your cost of goods manufactured. Okay, so here's practice. We made blue jeans. We had 68,000 of materials in inventory. During the month, we purchased 210,000 materials. On May 31st, materials inventory equal 22,000. What was the direct materials used in production? Okay, so they had 68 plus 210 that they purchased, so they had 278 available. They only had 22,000 left. So we subtract that out. We find they used $256,000 worth in production. Okay. Direct materials, they go into that work in process. Okay. Once the direct materials are calculated, the direct labor and the manufacturing get added to the work in process. So they got to add to the beginning. And then whatever's left still needs to be finished. Everything else moves out of the work in process inventory to finished goods. And then we move on to calculating our cost of goods sold. So in our cost of goods sold, we have a different formula. We're going to take our beginning finished goods inventory plus our cost of goods manufactured. That is the stuff that we just transferred out, that we just calculated. How much did we finish? That we transferred out of production and is available to sell. So that is called your cost of goods available, your COGA. Okay, remember that? It's your beginning inventory plus your cost of goods manufactured, everything you finished. Subtract out your ending inventory, and that becomes your cost of goods sold. It is your basic same cost of goods sold formula that we used when we did inventory in accounting 1. So here we got some information here. We made blue jeans during the month. We purchased the materials. We had direct labor cost of $135 and manufacturing of $150. Materials inventory equal $22,000. So it's given us the same thing as before. So we already know how much direct materials we used, right? Guess I shouldn't go backwards. It's at 256. We calculated that back on previous slides. You can flip back there if you need to rewind a little bit to show we got that. Give rid of our beginning materials plus our purchases minus our ending inventory showed that we used 256. The direct labor was 135. The overhead was 150. So the total cost that we put into manufacturing May was 541. There was already $50,000 in the work in process at the beginning. So our total production costs then were 591,000, but there was still $16,000 worth of costs that are not finished yet. So they'll stay in work in process while 575 gets transferred out to finished goods. That is our cost of goods manufactured. So then to find our cost of goods sold, it is the cost that were sold during the period, then transferred out from finished goods. Okay. This is the formula I was giving you. I was just giving it to you way ahead, like before they did, okay? So here's one more example we're gonna get through here, how to calculate the cost of goods sold, then we'll make an income statement, and this one's gonna be all wrapped up, okay? So Blue Denim Company makes blue jeans during the month, 150,000 per jeans were completed at a cost of goods manufactured of $575. So you notice that when it says cost of goods manufactured, that means all of that went into finished goods. That's what we can get conceptually from seeing that cost of goods manufactured. So they completed 115,000 pairs and that cost them $575,000. So now we know that we had 10,000 units in finished goods costing 50,000, and then May 31st, the company had 26,000 units in finished goods costing 130,000. A cost of goods sold statement. So we have our beginning. And remember, if we're going to do cost of goods sold here, we're not worried about the units. That's going to ask you to find number two. Cost of goods sold, we're worried about the dollar amount. So we had our beginning inventory of 50,000 plus our cost of good manufactured of 575,000 minus out our ending inventory of 130,000, telling us our cost of goods sold were 495,000. Okay, you can do the same thing with the units. We had 10,000 units to start with. We produced 115,000. 26,000 remained. Therefore, we had to sell 99,000 of them, and hopefully that matches our register tape and something didn't get stolen. Hopefully you're starting to see how these link together. How first we need to identify our cost. Is it a product or a period cost? Once we determine it is a product cost, then we need to determine, well, what is our cost of goods manufactured? How much of those product costs actually got completed? Okay, and then once we got how much got completed, well, okay, we want to know how much of those costs got sold. And then once we know that, then we can get to our final step here, the income statement. Okay, is your typical multi-step income statement, just as we did when we were talking about retail companies back in accounting one. Okay, first you have your sales revenue. Remember, revenue is how much we bring in for sale. It is your price multiplied by your units sold. From there, you're going to take out your cost of goods sold that we just calculated. I thought I had slides about this, and they're probably coming up. But that is called your gross margin. Okay. So let's see if it shows it in these slides. So recall here that we sold 99,000 pairs of jeans for the month. This is the same example we've been riding through all these slides. Total cost, remember we figured our cost of goods sold was 495. Let's say we sold each pair for $8. We have two types of selling costs, commissions and some fixed costs. So commissions are variable, 10% of the sales. The more we sell, the more it's going to cost us. And we have some fixed selling expenses. And then we have administrative expenses, and it's just giving us a total, prepare an income statement. So we go, sales revenue, 99,000 times the selling price, 792. Cost of goods sold was the 495, which we calculated 297 gross margin, gross profit. Okay, very important number. From there, we take out our selling expenses, commissions, okay? We had to figure out our sales, which we had up here, and 10% of that went for commissions, and then the fixed costs, and then our administrative, that becomes our operating income. And that's where we're stopping with our income statement here. Below that, if we were gonna go on, we'd have others such as maybe some interest stuff and then income taxes before we got to our net income. But this is operating income. This is the manufacturing operation. How much income did it create before auxiliary activities? It is a big number there. Okay, here we go, gross margin, sales revenue minus cost of goods sold. Shows how much the firm is making over and above the cost of the unit sold. So how much are we doing over our product costs? Okay, remember those product costs, materials, labor, overhead. That is stuff the manager can control. That's why it is such a big number, such an important number when it comes to giving out bonuses to managers, okay? Because we can control that gross profit, control materials based on waste, okay? It's not getting up and walking out the door either, theft, okay? Control your labor. Are we keeping our employees efficient out there? Are we working too hard? Are they getting proper training? Okay, overhead. Are we keeping our utilities as low as possible? Are we making sure the lights are off when they're not in use? Okay, are we being efficient with our machinery? Okay, are we doing proper maintenance on our machinery so bigger repairs aren't needed? You know, in order just to keep them running, stuff like that. That is stuff management can control. And that's why we break this down into the revenue minus the cost of goods sold. Okay, and does not equal operating income or profit as computed without subtracting out the other things. Okay, but it's making sure that our prices are good. And we can get a percentage from there. The gross margin percentage, we take our gross margin, or our gross profit divided by our sales revenue. And it really depends on your industry you're in here. Okay, grocery stores, their gross margin, it's really low. It's between 7 and 10%. Okay, so that means that when you're paying, you know, $1 for something in the grocery store, it probably cost the grocery store 93 cents in order to buy that product and sell it to you. And they're making an 8% gross profit. And that's not taking into account, you know, they're selling an administrative cost. Okay, so which is a good number. Other industries, say such as maybe a jeweler sells diamonds, they are probably going to sell less items, have a higher gross margin percentage. They're probably going to make 40 or 50, 60, 70% off each sell. They might buy a diamond for 10,000, turn around and sell it for 50,000, make a 500% profit in gross margin. Okay. Operating income is the very end. And as I said, operating income is your gross margin, taking out your selling and administrative expenses. Another term for those are your period costs. Okay. Kind of tying that all back together here. Yep, I thought that was the last one. Tying it all back together here. First is identifying those costs. Are they product period costs? Okay. If they are period costs, are they indirect, direct, selling, administrative? They're going to get expensed immediately. If they're product costs, okay, are they direct or indirect? If they are direct product costs, it's either going to be direct materials or direct labor. All other indirect costs become part of manufacturing overhead. Those are our 3 product costs: the materials, the labor, and the overhead. All of those go through the inventory process, from materials inventory to WIP inventory to finished goods inventory. Finally, when sold, get expensed as cost of goods sold. Sales minus cost of goods sold, or sales minus all the product costs, gets us our gross margin or our gross profit. And then our gross profit minus our selling and administrative or our period cost gets us to our operating income. And that ties a tight little bow there on the whole point of chapter 2. Good luck with your homework. I will see you again in the handout answer video.